Hi, and thanks for joining me today. Customer Power is a programme of research exploring the relationships that customers want to have with UK companies. We've previously looked at the financial services, mobile, pay TV and energy sectors, and today we're putting retail banks under the spotlight. I'm Georgiana Brown, a specialist in our financial services team, who's going to take you through today's webcast. This is our second webcast in our Banking Customer Power series, and in the words of Mahatma Gandhi, a customer is the most important visitor on our premises. He is not dependent on us, we are dependent on him. He is not an interruption in our work, he is the purpose of it. He is not an outsider in our business, he is part of it. We are not doing him a favour by serving him. He is doing us a favour by giving us an opportunity to do so. In essence, get the customer experience wrong and customers will exert their power and walk. And that is what we plan to talk through today: switching and brand choice. This webcast will then be followed up by two further webcasts, Digital Banking and Jumping Out of the Banking Box, where we talk about future innovations within the banking sector. So, with plenty of choice out there, why don't more consumers switch bank accounts? In our first session, we spent time talking about how and why trust within financial services has been eroded, with misdemeanours spanning over 3 decades. However, whilst the industry may attain low levels of trust, people do still trust their own bank, and we showed that, although there is certainly room for improvement, many do have the relationship they want with their bank, with 48% completely agreeing or agreeing, a further 37% slightly agreeing, and just 15% disagreeing. Given so many are having their expectations met, why should they even contemplate switching? Following an inquiry, the Independent Commission on Banking, the Payments Council last year launched the 7-day switching service, and it has achieved some success, though there is a far greater challenge ahead. Over half of all bank customers never review their needs. 60% also believe that all banks are the same, and almost a fifth of customers believe it's all a bit Kylie, better the devil you know. Now that the switching process has been improved, it's high time that the banks, the government and the new Commission focus on how they can disrupt this state of play and challenge how people think about their banking needs. As sure as rain at Glastonbury, people will not switch banks until they think there's a tangible benefit to doing so. Banks and the powers that be also need to challenge consumer attitudes and mentality. Perhaps this is where the levels of distrust within the macro environment do have an impact, and maybe consumers need more of a real response to this. Even those who have shown a predisposition to switch are not always motivated enough to make that final step. Here is some very interesting research conducted by the Payments Council and which is freely available on their website. According to their research, 8% of all account holders considered switching their bank account within the last 12 months, but eventually decided not to make the move. Again, when we take a look at the reasons why, the story that really comes through is that the benefits of switching just weren't motivating enough. Prospective switchers simply did not get round to it, or for almost a fifth, they claim to be happy where they are, or that it's too much hassle despite the switching service, whilst 1 in 20 claimed that all banks are the same. So who does have a predisposition to switch? Let's take a step back to our last broadcast. At Harris, we analysed the relationship strength an organisation has with its customers via the Harris Relationship Score. This is measured on 3 different dimensions: rationally, in terms of how they think about an organisation, emotionally, in terms of how the organisation makes them feel, and then a forward-looking metric to gauge how they intend to act in the future. A relationship score is then produced for each customer that defines how connected they are to their bank, so we can identify those who are fully connected, right through to those who are disconnected and at risk of switching. We can then place customers into different segments according to their connectivity. We can clearly see there's a lot more work to be done by the sector as a whole to generate truly connected relationships with customers. We also see the challenge in dealing with a high proportion of customers who appear indifferent to their bank, and 9% who are at risk. So why does this matter? From our online survey, we found just under half of all bank account holders have ever switched, with 7% within the last 12 months. Looking forward, 13% claim to be fairly likely to switch within the next 12 months. When you look at our relationship model, you can clearly see it's the disenfranchised customers that are significantly more likely to be looking to switch in the future. Clearly again an indication that churn is perhaps due to customers simply wanting a better service, rather than being motivated to switch by more attractive offers from other providers. We have briefly talked about the new switching service. Aligned with the Payment Council's switching report, we've also noticed strong growth in the awareness of the scheme. But what impact has it actually had? Here we're looking at those who stated they were aware of the scheme and their propensity to switch in both October 2013, just a couple of months into the new scheme, and again in May of this year. At first glance, there doesn't seem to be much to write home about, as those who say they are definitely likely or very likely to switch hasn't changed that much at all. However, when we look at the other end of the scale, we can see those saying definitely not has significantly decreased, with those saying they are unsure doubling. Clearly, based on the evidence held within this survey, we cannot attribute this change solely down to the introduction of the switching service, but nevertheless, it is certainly an interesting change and a very small step in the right direction. So how can greater volumes of switching be encouraged? Until recently, all the major banks offered the same type of services to their customers and prospects. They all primarily had a one-size-fits-all strategy. Yes, we have seen the growth of the basic bank account, and we saw the introduction of the added value or packaged account in the late 90s. But really, are we honestly saying that 3 different types of accounts are enough to meet the needs of the UK population? Even the smallest coffee stand offers you more ways to get your morning fix. So what is truly different about banks today? Clearly, what is needed to jolt the sector into greater levels of competition is some sort of disruption. To be fair, this is already beginning to happen in the form of new competition from the likes of Metro, M&S and Tesco, all of whom have entered the market in the last few years. And we're all eagerly awaiting the arrival of Virgin. But will that be enough? Honestly, I doubt it. Even the growth of peer-to-peer lending is only really happening at the margins. We also see the digital disruption beginning to take place with the growth of online, mobile platforms and wallets, and even new currencies. But with many of the main banks launching similar platforms, with similar features at the same time, what true differentiation is actually taking place? And even if it is, do consumers actually know about it? Could it be true what Bill Gates said way back in 1994? Banking is necessary, banks are not. Perhaps the true digital disruption will actually come from somebody completely outside the sector, an organisation that sees the true value in transactional data. The fact is, to stimulate greater levels of competition, the sector needs a real shake-up, one that challenges how UK consumers think about their banking needs. Back in 2011, Andrew Bailey, then the Executive Director of the Bank of England, claimed there was no such thing as free banking. He went on later to say that until free if in credit banking is tackled, the country cannot move ahead. He does have a point. Since its introduction in the early 80s, free if in credit banking has helped create an environment where customers take the services provided by the banks for granted. Could it be the old adage, you don't value what you don't pay for? It has also significantly stifled competition, as consumers rarely review their needs, and competitive pressure forces the banks to keep the status quo. Many in the industry believe the market does need the electric shock treatment which ending free if in credit banking would provide. Customers would begin to value the service provided by the banks. They would be forced to review their needs and be awakened to the benefits of switching. On the other hand, any change of this magnitude would likely be met by fierce resistance amongst many who don't have a problem with the status quo, or just don't feel they should have to pay for a bank account. Clearly a political hot potato. The banks would need to ensure that any changes of this nature are tailored to fit the different needs of customers, including those who are struggling financially. But it is true that the last few decades have seen huge changes in many areas, and it would appear that the banks have struggled to keep up with the times. Where's the proof, some of you may be saying? What would happen if every bank charged for a bank account? We simply asked all bank account holders to what extent they would agree or disagree with the following statements. If every bank charged, I would pay more attention to service levels and benefits I receive. And if every bank charged, I would be more likely to switch. As can be seen from the slide, 3/4 of account holders at least slightly agree they would pay more attention to the service levels and benefits they receive from their bank if every bank charged, with almost half completely agreeing or agreeing. That has to be beneficial for the sector. When looking at the impact it could have on switching, again we see some positive movement, with well over half slightly agreeing that if every bank charged, it would increase their propensity to switch, with around a third either completely agreeing or agreeing. Again, if the aim is to get more people to pay more attention to a service that helps people function in their everyday lives, these statistics are certainly a push in the right direction. So, amongst those looking to switch in the future, where are they planning to go? What is very interesting to see is that Nationwide and Santander are the top two. Both of these providers are in the top 3 in terms of how they manage their customer relationships today. They are then closely followed by Lloyds, and then comes Virgin Money. Now, considering that Virgin haven't even launched their bank account yet, that is quite a score. There are of course other non-banking brands that people will also consider, and the likes of Tesco are in the list, who've just launched their account, and even John Lewis and Sainsbury's. This just goes to show there is a segment ready for something different, something perhaps the traditional banks will struggle to provide. So what are those who have recently switched and those who may switch in the future looking for? Let's look at the top 10 for both. Interestingly, a number of the attributes are the same that drive loyalty, such as service provided, listening to you, and easy to understand products. But both recent and future switchers are also interested in value, overall quality of the banking site, and being treated as an individual. Those who have recently switched are also looking for simplicity and ease of use, and in particular communication at a time and via the channel that they want. Fundamentally, it's about understanding their needs and tailoring an approach accordingly. Interestingly, this is in stark contrast to future switchers who are looking for deals and value. They want rewards and competitive fees alongside innovation in terms of products being relevant and pushing the boundaries. As we know, switchers of yesterday are most likely to be tomorrow's switchers as well. Another way that we understand and explore customer preferences at Harris Interactive is through brand mapping. In this simplified example of a needs map, we have taken just the attributes that are covered by 2 brands you will see in a moment. On the chart here, you can see a variety of features covering the areas of communication, value and fees, tailoring and access, and product and service. The features customers judge as being of most importance in a bank account if looking to switch are placed towards the right-hand side of the map, with those of lesser importance towards the left. You can see that simplicity, value for money, and rewards for loyalty are at the top end for consumers, with a personalised service and a mobile banking app scoring as relatively less important in comparison. Using current customer ratings, we can then overlay brand maps onto the needs map we have created, allowing us to see how well a brand meets the needs of consumers. Let's have a look at those top 2 choices to switch to then, Nationwide and Santander. Santander first, people's second top choice of who to switch to. And you can see that it's particularly strong in terms of product and service. It's felt to reward loyalty, understand customer needs, and respond well to and solve any problems or requests. Its brand map doesn't go into our bottom section though, indicating that in comparison with other brands, it's not seen as being especially flexible in terms of tailoring its service to the customer. Its map also does not cover value for money, one of the most important areas for consumers. And here is Nationwide, people's top choice of who to switch to, and it's apparent immediately that its map is larger than Santander's, covering more features and sections of our needs map, including key areas of rewarding for loyalty, simplicity and value for money. When this is how its current customers view it, it is not difficult to see why it tops the list of most likely provider to switch to amongst those considering making a move. And here we have them together. In red, we've highlighted the features where Santander stands out, but Nationwide doesn't, dealing with problems and requests. And in blue, we show where Nationwide has the edge, but Santander falls a little short: value for money, innovation and tailoring. As these are our top two choices for switching, it's interesting to see where their brand maps overlap, as this gives us an indication as to where others should be looking to improve if they want to move higher up the consideration list. 4 features overlap. On the left, we have quality mobile banking app. Whilst relatively less important to consumers, in fact this came lowest of all our features, including many that we haven't shown here. This perhaps reflects a more forward-looking brand. It'll likely appeal more to younger consumers, and it may well increase in importance over time. At the top then we have understanding needs and rewards loyalty, both core service offerings. And on the right we have simplicity or ease of use. This is the second most important feature to consumers overall, just behind value for money. And this rounds things off nicely, as a reminder that at the end of the day, a bank or building society can throw as many offers or new features at a consumer as it likes, and it may well start charging for it. But they have to keep it easy. In a complex and ever-changing world, it's little wonder that consumers demand simplicity in managing their everyday finances. Those that can simplify their offerings, whatever they may be, and show that they understand and will reward their customers, are those that will stay or move up on top of the pack. And now there's just time to sum up what we've covered today. Levels of bank account switching remain low, despite increased awareness of the current account switch service. Whilst on the surface it would appear that many are happy with their bank, it is in fact more or less the case that they don't review their needs and see all banks as the same. There is a segment of disenfranchised, unhappy customers who are considering switching and would be more likely to do so if they saw a real benefit to it. This may come in the form of the demise of free if-in-credit banking, as banks are forced to compete harder and consumers value what they pay for. And finally, value for money, rewards for loyalty and simplicity are key needs of consumers, and they will look for these in a provider if looking to switch, with Nationwide and Santander currently standing out in these key areas. Thank you very much for your time, and do get in touch with us if you'd like to hear more.